Hey everyone, Adam Bergman here for another episode of Adam Live. This is kind of a weekly lunch and learn, I would say. So hopefully, if you missed this live, then you can check it out next week. Every week, Wednesday, 12 o'clock Eastern Standard Time, noon, around lunchtime, if you like an early lunch. So we're going to have some fun today. We're going to talk about the proposed tax bill, which was proposed and presented by the Ways and Means Committee back in September 12th, and talk about the potential impact on real estate investors. So I got a lot of feedback from my content, some good, some positive criticism, which I'm all for. And one of the sources of feedback were, hey, Adam, it would be great to check out more content on real estate investing and what the proposed tax bill could do or not do. So that's what I decided to do this week. And I'm going to break this up into two segments: bad news, good news. And unfortunately, I'm going to start with the bad news because there's more bad news than good news when it comes to this proposed tax bill, even for real estate investors. So let's just jump right into it. I know you guys have busy schedules, so I appreciate you spending some time with me today. Again, if you miss today's live because you got more important things to do, I got you. I feel you. Don't worry about it. You can check this out anytime you want on the IRA Financial channel. It's there. It's free. Great content. So subscribe. What are you waiting for? So let's start with the first item of bad news: higher capital gains tax rate. The proposed bill would increase the capital gains tax rate from 20, I should say, to 25%. So most real estate investors are focused on capital gains treatment. The current tax rate is 20% for long-term capital gains. That means holding the real estate asset over 12 months. So this proposed bill will reduce it to, or increase it, I should say, to 25%. So that's bad news. You'll see if you wait in the next little while. I'll get to the good news. And actually 25% is better than just 40%, which some people thought would be implemented for income over 40%. So, or income over $1 million, I should say. So not great, but could be worse because some of the Biden initial proposals were a 40% tax for $1 million plus of capital gains income. And this has been reduced to 25% across the board. There's no $1 million threshold, but it's 25%. Number two, the proposed bill seeks to end the mega backdoor Roth IRA, which has been a great way for real estate investors to get more money into a Roth IRA. So since 2010, you're able to do Roth conversions without income limitations. And a popular strategy has been the mega backdoor Roth IRA, which has allowed anyone who makes over $208,000, which is the Roth IRA contribution cutoff for 2001 from an income limitation threshold. Now, at least up until 2022, you will be able to still do backdoor Roth IRA conversions, contributions, so you can go 6,000 or 7,000 if you're over 50 to after tax to Roth. So that's another way that real estate investors have been utilizing as a way to get more money in a Roth. The advantage of having a Roth for real estate investors is you can lock in tax-free gains on all your assets, so long as the Roth's been open 5 years and you're over 59 and a half. Now that, at least the backdoor Roth, will be eliminated if the bill passes in its current form starting in 2022. The next one is the mega backdoor Roth 401k. So the mega backdoor Roth IRA is good, 6 or 7K, but if you're self-employed, the mega backdoor Roth 401k will let you go 58,000 or 64,500 into a Roth each year. Now, unfortunately, this will also be eliminated per the proposed tax bill. So this could be your last opportunity in 2021 if you're self-employed, you're a real estate investor, a real estate professional, and you love Roth, then this could be your last chance to dump 58K or 64.5 into a solo 401k. This could go bye-bye in 2022. And this has been a popular tool for a lot of my real estate clients who are big Roth lovers, and their strategy has been, okay, I will basically live without the current tax deduction, but my goal is to dump more money into a Roth so I can shelter more of those gains from the Roth 401k investments going forward. So that will be eliminated. It's too bad because this is not a revenue raiser, right? Roth IRA conversions, mega backdoor Roth 401k, they're not revenue raisers because you're going after tax to Roth. You're not going pre-tax to Roth. So it's not raising any revenue. It's not hurting revenue because it's after tax to Roth. They're not even adding an income limitation to it. They're just saying you can't do it going forward, which is troubling because who are doing these strategies? It's small business owners, right? It's real estate professionals like you who just want to save a little bit more into a Roth IRA or Roth 401k each year. Why are we hurting those types of folks? Doesn't make sense. The super wealthy, the hedge fund billionaire, the Elon Musk, the Peter Thiel, they don't care about $6,000 or $7,000 in a mega backdoor Roth. They don't care about adding 50 or so thousand to a mega backdoor 401k. That's not what they're going for. So it's troubling that these provisions were even inserted into the proposed tax bill, and we'll see if they actually make it into a final bill. Where we stand today, we know that Speaker Pelosi basically is given till the end of the month to come up with a deal on reconciliation and somehow connect it to a reduced budget reconciliation bill, probably going to go between 1.5 and 2.5 trillion. And the idea is to try to combine these and get these passed simultaneously, which will make the progressive wing of the Democratic Party happy. And that's something that the Democrats are seeking to do. We'll see what happens. I do believe something's getting passed. It's suicide, political suicide for the Democrats to not get anything passed this year with elections coming up again next year. It's just not going to happen. So they'll get something passed. We'll see what part of these tax proposals get inserted into a final bill. I'm hopeful that the mega backdoor IRA or 401k somehow don't make its way into a final bill because they're not raising any revenue and they're only hurting small business owners and real estate investors like yourself. So we'll see. But again, if you are disappointed with these provisions and feel like they will have a negative impact on retirement savings for low to middle income folks, reach out to your members of Congress, reach out to your senators, express yourself. They will listen to you. They certainly are interested in what you have to say, and please do it. It will and can make a huge difference. Conversions. So after 2010, anyone was able to do a Roth IRA conversion. Why? Because Congress realized that it's a good thing. Why? Because people pay tax now instead of waiting to pay tax on IRA distributions in the future when they hit the age of 72. But this bill seeks to eliminate Roth conversions for those earning over $400,000 if you're single, $450,000 if you're married, filed jointly. Why are they doing it? I don't know. Again, it doesn't make a whole lot of sense because who pays more tax? It's people that make over $450 are going to be in a higher tax bracket, are generally the ones with probably a higher amount of retirement funds to convert. So they're actually taking money out of their pocket. Why? They somehow believe that there's valuation trickery going on by wealthy people. I don't see it. I got 30,000 plus clients. We require valuations for conversions. So people aren't just making up numbers. They have to have a third party essentially accept and confirm the valuation they're presenting. So it's disappointing again. I guess they think there's a lot of Peter Thiels out there that are converting unappreciated private stock. It's not happening. And I think they know that because one of these proposed bills seeks to extend the statute of limitation for the IRS for retirement accounts, or at least IRAs, from 3 to 6 years. And guess what? They expect that to raise only $12 million over 10 years. So if they thought there was a lot of abuse, you would think that number would be way, way higher than $12 million. But I think this is more of a policy thing where they just don't want, where they perceive wealthy people having more Roth strategy options. And $450 grand is a lot of money. Don't get me wrong, but it's not uber wealthy money, right? It's not someone who makes $2.5 million or $3 million. If you're one lawyer, one doctor, two lawyers in a family, an executive and a lawyer, like you may be around the 450, especially if you have other passive income like real estate. So, and again, I know a lot of real estate investors that have over 450 and they don't consider them super wealthy. So what this provision seeks to do is eliminate conversions for those folks. I think this is actually going to be a revenue loser for Congress. Again, maybe this doesn't get in because it's not going to raise enough money, or it's actually going to hurt their ability to raise money, or not. Maybe they just feel like this is a good policy play. And since the infrastructure reconciliation bill will drop from, let's say, $3.5 trillion to maybe $2 trillion, they can live with this stuff. The next one on the bad news list is the qualified business income deduction, which is now you get a 20% deduction for pass-through income if you have a business that is operated through a pass-through entity like an LLC or even an S corp. Now, there is an income limitation, which basically says this: if you make more than a certain amount today, which is around 300 or so thousand, actually 329,800 and 164,900 if you're single, you can still get this 20% deduction, but now there's a criteria that you need to satisfy. Basically, you can't be in any of these categories like health, law, accounting, performing arts, consulting, athletics, financial services, or you can't receive fees from other income for endorsing products, licensing, or receiving fees for appearing at events. So they've kind of reduced the category of income that's available for that 20% deduction, but you still can potentially get it. They just didn't eliminate it. The new rule basically says this: if you make more than 500K, you can't get it. Okay, it's 400 for an individual, 500K for married filed jointly. If you make more 500K, irrespective of your business, you cannot get the 20% deduction for pass-through business income. This also impacts you, real estate investors. In many cases, real estate investors operate through pass-through entities, and if they treat that income as active business income, there's a potential 20% deduction. Section 199A now makes it easier to treat your business, especially in the real estate context, as a business, because there's safe harbor rules that you can satisfy to make sure your business is treated as, or your activity is treated as a business. This provision will basically say, hey, irrespective of what your real estate business is doing, or any business in that sense, if you make more than 500,000 married filed jointly, 400,000 single, you can't get the 20% deduction. Okay, so this is a pretty biggie, especially for real estate investors who were able to get around some of these rules. Even if they made more than the 329, they were able to get into the 20% deduction. The current provision as proposed will eliminate all these, this 20% deduction for anyone making more than the 500K filed jointly. So that's not a great thing for real estate investors as well. Next one on the bad list is the 3.8% investment tax. So this 3.8% net investment tax currently applies, right? But it doesn't apply to businesses that are pass-through businesses that operate, have a business in the ordinary course of a trade or business. So right now, the 3.8% investment tax essentially applies to high income earners, but it didn't apply to trade or business income as well. The proposed provision will expand Section 1411 to apply to net investment income for ordinary course of trade or business. This is a biggie also for real estate investors who are operating their business in the real estate context as a business and not a passive activity. Now you will also be subject to this 3.8% tax if you have income over 500K or 400,000 if you're single. So it's expanding the net investment tax to also business income, not just high net worth or trust and estate. So another biggie that is stuck into this provision that is there to essentially force high net worth people into paying more tax. Now, is 500,000 too much income or not? It's an arbitrary number. Some people would say that's a lot of money. Others would say it is, but it's not for the uber wealthy. Either way, if you're a real estate investor, now make over 500K married, file jointly, you're going to be subject to a 3.8% investment tax, even on your business income. Plus, you're going to lose the 20% pass-through deduction as well, which kind of hurts. So it's like a double whammy here. You lose the 20% pass-through deduction, and you also get hit with 3.8% investment tax, which goes on top of the capital gains tax of 25%. So now that's 8.8%. Plus you lose the 20% pass-through deduction. Plus your ordinary income tax rate is now, if you're a higher tax bracket, is going to go from 37 to 39.6%. So you see what's going on. They're just layering taxes on taxes. And it hurts all taxpayers, but it's also going to hurt real estate investors, which is becoming a larger and larger segment of this population. With real estate assets appreciated 30 to 40% in the last year, more and more real estate investors in this country will see greater gains from sale of real estate assets, greater income, rent will go up. We're dealing with inflation. You're going to see more and more real estate investors hover in a higher tax bracket. And if that's the case, you're going to lose the pass-through deduction now that your activity is treated as a business, if it is. Plus, you'll get hit with the 3.8% investment tax. Another item on the bad list is $5 million income. If you make more than $5 million in a year, and this can happen, right? You sell real estate, you sell an asset you've held for 10, 15, 20 years. Now you got over $5 million of income. You're going to pay an excess 3% surcharge. So let's add the layers up, right? Capital gains tax has gone from 20 to 25. You have that 3.8% surcharge. Now you're 28.8. You lose your 20% pass-through deduction. Plus you have another 3% surplus if you have income over 5 million. So I talked to an accountant in New York who told me that, Adam, I got a client that is potentially going to sell an asset of over 5 million next year. And he lives in New York City. So we estimate that he's going to pay around 41% long-term capital gains tax. That includes, of course, city and state. Now, if you live in Florida, like me, and I moved from New York for a reason, guess it's making more and more sense every day now. You're probably going to look at over 5 million. You're going to be 28.8 with the 3.8% surcharge plus another 3%, getting you around 31.8. Lose my pass-through deduction. Probably no state and local if it's not a corporation. So I'm over 30, close to 32% long-term capital gains tax. So it's creeping up there, right? It's not 40%, which is what the Biden administration proposed on income over $1 million, but as you can see, it's creeping up there. So just something to be aware of. That's the bad news. Okay, let's get to the news. There are some good news items here. Believe it or not, there are some good news items. Number one, 1031s were not touched by the proposed tax bill. Pretty good, right? There was some rumors circulating before September 12th that 1031s for real estate could be hit. Basically eliminate 1031s. What is a 1031? Basically allows a real estate investor to defer tax by selecting a like-kind property within 45 days and closing within 180 days. And by doing that, you could keep increasing your real estate portfolio without paying tax. That was not touched by the proposed tax bill. That's a big winner, in my estimation. Big winner. Number two, the step up in basis was not touched. Okay, so what a step up in basis means is if you have an asset at a value, a basis, let's say of $100, and when you die, it's worth $500, your heirs get that asset at a stepped up basis of $500. So the built-in gains tax of the $400 in this example will evaporate and not be subject to tax. So that's really good. Now, and that's been a hallmark of our estate planning system for 100 plus years. Now, the Biden administration talked about removing the step up in basis and essentially saying, listen, if you die with a asset that's appreciated, and they would have given you some type of income window, whether it was $1 million per person. If it's above that, you're going to pay 40% tax on built-in gains from step up asset basis. They decided, at least the Ways and Means Committee, Democrats decided not to include that in the proposed bill. And what they supposedly did instead is they added that 3% surplus for gains over $5 billion to counteract the fact that the step up in basis elimination never got inserted into the bill. So that's a win. The step up in basis, again, is a big tax planning tool, and has been used by many, many taxpayers for 100 plus years. And if that was touched, that would have been a big, big, big bad news item, but it never made it in there. And then again, I mentioned this, the proposed capital gains tax rate, that could have been 40% for income over $1 million. That never made it into the bill. Capital gains tax rate now simply went up from 20 to 25% for all income over a threshold. There's no $1 million threshold any longer, and that's for long-term capital gains. Short-term capital gains, of course, is still taxed at the ordinary income tax rate. So those are only the winners. I would throw another winner in there is the unified credit, the lifetime exemption, which is now $11.7 million per individual. There was a rumor that was going to go down to $3 or $3.5 million, and it's now going down to about $6 million per individual. So not great, but not disastrous either. Estate planning. I kind of wanted to go back to estate planning and talk about it, and unfortunately, I'm going to have to put it on a bad news item list because I did talk about the unified credit, which is now 11.7, which at least didn't go down to 3 or 3.5. It went down to 6, which is not great, but not horrible. The proposed tax bill seeks to eliminate grantor trusts, or at least the benefits of grantor trusts. And what are some of the benefits, especially for real estate investors? A lot of real estate investors try to put assets into a grantor trust, protect those assets from creditors, and also from estate tax. Now, the proposed bill, if it's passed in its current form, will eliminate those benefits and basically not allow you to put appreciated assets or underappreciated assets, I should say, into grantor trust and have them escape creditor attack as well as estate tax. So that is another really negative item that I should have put on the bad news list, but now I'm going to kind of subsequently do that. So just to recap before I get into some questions, bad news, income tax rates for higher income earners going up, capital gains rate going up to 25%. The mega backdoor Roth IRA will be eliminated. The mega backdoor Roth 401k will be eliminated. The grantor trust provision or benefits will be potentially eliminated. Conversions will not be allowed for those making over $450,000 married filed jointly. The qualified business income deduction, that 20% pass-through deduction, will go away for those earning over $500K married filed jointly. The 3.8% investment surcharge tax will now apply to active business income and will apply to those that make more than $400,000 or $500,000 married filed jointly. So that is now a biggie because it also applies to business income. The surcharge, 3% surcharge of income over $5 million. That's also could hurt potentially some real estate investors that have a potential home run capital gains event with a real estate asset that will potentially impose a higher tax. So again, if you kind of stack these taxes up, big capital gains transaction over $5 million, 3.8% surcharge, 3% on top of a 25% capital gains tax rate, on top of any state and local tax, you're looking at potentially 32 plus tax on long-term capital gains for certain high income earners. That's pretty considerable. I didn't mention the corporate tax rate because a lot of real estate investors, most real estate investors, do not own real estate in a C corp. So the C corp tax rate is supposed to go from 21 to 26 or so. That generally won't impact a lot of real estate investors because they generally use pass-through entities like LLCs or S corp. So that's kind of not a big issue. Some questions. I'm a brand new customer. A couple of very complicated questions. You could email our compliance department. If you email compliance at IRA Financial, or if you email info at IRA Financial, or you know what? you can email me. If you email info@IRA Financial and just put it to my attention, it will get to me. I'm always available to answer anyone's questions. Even if you're not a client, you can email me at info@IRA Financial. Just include on the subject, Ask Adam. You can hit us up on Instagram, Facebook, Twitter, YouTube. Leave a comment on our video. I'll get back to you. I spend a lot of time going through comments, going through social media feeds. I do my best to get through all questions. I got a lot of questions that I need to get through today, which I'll try to, from clients regarding the various tax bill and other matters. So I'm here to help. This is what I love to do. This is my passion. I don't just do it as a business. I really care about helping people and care about this area. As a trained tax attorney, I decided to go into tax law because it's something that resonated with me. It's the only area of law that made sense to me. Everything else didn't. I don't like fighting with people in court. I've actually never been in court in my life. I'm a transactional attorney, and I just like tax because it's super interesting to work with the tax code, kind of help people minimize tax. It's like a puzzle, and it's a lot of fun. So it's my pleasure. Even if you're not a client of IRA Financial, shoot me an email or a message on social media or through YouTube. I got you. Would leverage Forex trading via Roth trigger UBIT? Yeah, anytime you use leverage, whether it's margin, and in fact, if you use margin for Forex trading, you can't personally guarantee it. So it's something you should be aware of, because some cases, if you use leverage, you're going to require a personal guarantee. And if you do it for Forex trading, it will not only trigger UBIT, but it could trigger a prohibited transaction. So number one, make sure you are not personally guaranteeing the loan. If that's the case, then you still need to worry about UBIT, on top of the fact that Forex trading, could be super risky. So, just be careful. I'll start the email, rather complicated, maybe not to you. Give me a couple days. You can send it to me. The more complicated, the better. That's what I love. Joe, have you heard any update on the proposal regarding non-public assets and securities? Yeah, I was going to get to that, Joe. So for those listening or watching that haven't been caught up to speed of what's going on, the self-directed retirement industry has been fighting 138312 and 138314, two provisions in the proposed tax bill. 138312 seeks to stop IRA investors from investing in private placement investments or any investment that requires someone to be accredited. That could be private equity, hedge funds, investment funds, Reg A's, Reg D's, even actually annuities. I did some work, and actually I spoke to a really brilliant attorney that I talked to, that kind of sent me information on her work, which was brilliant. And basically, her thoughts, and I think she's right, is that variable annuities, which of course, members of Congress are super supportive of, could actually be basically prohibited based off 138312, and the fact that certain investors need to give certain asset or income classifications in order to get into a variable annuity. And based off the broad drafting of 138312 and its broad scope, it may actually capture variable annuities and basically prohibit investors in an IRA from doing it, which I know is not the intent. And that's basically our industry's position, is like, listen, you have questions on retirement accounts, IRAs, that's okay. We're here to talk to you, members of Congress, members of Ways and Means Committee, their staff. We want to talk, we want to be engaged, but is this the right medium to do it? Shouldn't we talk? Shouldn't you have proposed regulations? Shouldn't you seek public comment? This way we can all do this together and make sure that the way these provisions are drafted aren't going to hurt everyday Americans that are basically the unintended victims of these bills. But unfortunately, these provisions got snuck in. There was very little dialogue, if any, from our industry. And our goal now is to educate members of Congress, senators, on the jarring negative impact 138312 could have. Now, 138314 is super broad too, and it basically will stop IRA investors from investing in any company, private or public, in which they own 10% or more, or any private company in which they're officer of, even if they own 0% of the company. So those are super broad, and we feel, and many do feel the same way, that it will extremely denigrate the ability for small businesses across the country to raise capital, right? With $12 trillion in IRAs, IRAs are a very valuable source of capital formation for many small businesses in the United States. And we need to compete, right? We need to compete with Europe. We need to compete with China. And with $12 trillion of funds, to simply just remove them as a capital formation option is tragic. Okay. And I have many, many clients, and so do my competitors, that have helped amazing businesses grow, and some even become public companies, some not. Some just become super successful companies that, employed hundreds of Americans. With 65% of all Americans employed by small businesses, by taking IRAs away from a potential capital raising option, it's tragic. And again, I'm not sure that the individuals that wrote this bill really understood its potential impact. Clearly, what they're trying to do is stop the next Peter Thiel, right? Peter Thiel was, at least seemingly based off a ProPublica article that was driven by stolen information from the IRS, was able to assumingly generate billions of dollars in a Roth IRA by investing in private companies like PayPal, Palantir, and Facebook. And members of the Ways and Means Committee, at least their staff, seeks to eliminate that. And they've done that in a number of ways, right? They've essentially included a provision that will cap all IRAs, not just Roth IRAs, but all IRAs at $10 million, okay, which that will stop any potential Peter Thiel. And they also have included 138312 and 138314, which we believe is unnecessary and overboard, and would be detrimental to America, its economy, and the amazing businesses in this country that want to grow, that want to compete, that potentially can be the next great American business. So we're working hard. We need your help. We have daily calls with our lobbyists. We are making great headway. We are daily in communication with members of Congress, their staff, senators, just educating. We believe in working with the members of Congress and senators and their staff, just educating them, right? We're not hiding anything. We believe our industry is a very, very important resource for businesses in this country to raise capital. We also believe in the power of diversification. And we ultimately believe that once we get our point across to the requisite members of Congress and senators, they will see the importance of self-directed retirement industry, the importance of diversification, and the importance of job creation by the use of self-directed IRAs through private placements, hedge funds, private equity funds, Reg A's, Reg D's, or just private investments. So 138312, 138314, would be a just a tragic turn of events if those provisions get passed. We are under the impression, at least, that they're reworking it, they're listening to us, and hopefully we can get these provisions at least either removed or drafted in a way that will not hurt American businesses and will not hurt retirement investors' ability to diversify. So that's where we are. I haven't given an update session. I may want to do one next week, but I think with infrastructure and reconciliation not happening until the end of the month, so we're kind of in a lull. It's like we're in a marathon. We're kind of in mile like 12 or 13. So we just got to kind of keep our pace, keep our head down, keep working, keep educating anyone that will listen to us about the negative impact these provisions could have on America. It seems like if large pension funds can invest in non-public assets, small investors should be on parity. Yeah, Joe, you're 100% right. 138312 and 138314 do not apply to 401ks or pension plans. Why? I don't know. But clearly, they understand that large pension funds like CalPERS do really well when they invest in alternative assets like private placements. So they're seemingly still allowing those investments to go through a 401k, but are eliminating them for you and me, the everyday investor that actually needs these benefits, right? We need the ability to diversify. We need the ability to supercharge our retirement because we may not have enough when we retire. We're dealing with inflation. Social Security, who knows? They're increasing Social Security, I just read, by over 5% next year. Is that something that is workable over the next 20 or 30 years? I don't know, right? Where are we? We're in stagflation, we in inflation. So yeah, I think the best thing we can do, and the whole, essentially the core of the retirement system, is a private retirement system based off you and I making contributions and you and I controlling our future through annual contributions via IRA or 401k. And by eliminating investment options, you're simply going to turn people off making investments through their retirement account, and we'll force them to do other stuff, whether it's just to buy real estate through personal accounts or just to spend. It's going to de-incentivize people to save, which is tragic and certainly not the type of policy I think members of Congress should be pursuing. So, Joe, I'm totally with you. Great points. Thank you. I got another question here on the cap. Adam, can you talk about the cap's focus on earners under certain income threshold? So, yeah, I mentioned that there's provisions in the bill that will cap all retirement accounts above 10 million. However, there's also an income threshold. So that only applies, that cap, if you have more than 450 in income if you're married, filed jointly, or 400 if you're single. So if you're able somehow, and they're basically saying, listen, we're throwing this in there to basically say, oh, if you have 10 or 15 million dollars in an IRA or Roth IRA, and you have income at like 300,000 bucks, you can keep your high retirement plan. So it's a way to basically give you a carrot and say, hey, this is just really for the uber rich. So we think 450 is a cutoff line if you're uber rich or not, which is arbitrary and I'm not sure accurate. 450 in New York City, you're not uber rich. Trust me. I got friends that make that, and they're still paying off student debt. So that at least is their cutoff, and they're basically saying, hey, you make 250, 300, and got a $20 million IRA, you can keep it. But it's just not. It's just so unrealistic, right? How many people in this country that have saved over the years, whether they're in their 50s, 60s, 70s, and have $15, $20 million in an IRA, have less than 450 in income. It happens. I actually know of a few of them, but it's not going to be something that's very consistent across the board. So that is the way it works. There is an income qualifier for the cap. I'm not sure it's going to be able to help many people, but that's what it are. The cap really only hurts people that have more than 10 million if you're under 59.5. Because if you're over 59.5 and you have 10 million, in a Roth IRA especially, you can always pull that money out tax-free anyway. So if you had, let's say, 20 million in a Roth IRA, you're over 59.5, the Roth's been open at least 5 years, you can just pull that money out tax-free. It's not a big deal. But if you're 53 and you have money in a Roth IRA, pulling that money out could be subject to tax and a 10% penalty. Now, we're hearing that these provisions, at least on the cap, if you have to take required distributions based off the cap, you may have to pay tax on the Roth IRA funds above the amount contributed or converted because you're under 59.5, which is crazy, right? So again, this is another example of someone who could potentially, and that's why they have that 450, right? It's trickery. Why? Because President Biden said, hey, if you make less than 450, this bill will not increase your tax $1, right? It's all just political games. So here they threw the 450 in there and saying, listen, if you make under 450, we're not going to make you take a taxable distribution in your Roth or traditional IRA. You're good. But if you make more than the 450, hey, you're fair game. We're going after you. So it's all a game. So this way, President Biden can say, hey, I told you, if you make less than 450, I ain't going to bother you. You're good. This is going after the uber rich. Although I'm not sure if you're uber rich, making 475 or 500 is something that is fair. If you make 10 million or 5 million, okay. If these income thresholds were, hey, if you have a $10 million IRA and you have more than $5 million of income, we're going to make you remove it. Okay, I can accept that to some degree. But 450, God, married, you have two income earners, you sell your house or you have an investment, 1 year you may be over that 450. So again, it's an annual test. Just troubling. So again, it's all just political game, because now President Biden can say, look, if you make under 450, this tax bill is not going to impact you. Actually, the two provisions, 138312 and 138314, will hurt people that make under 450, because the way it's written now, you have 2 years. If you currently have an income in a private investment like a Reg A or Reg D or a private placement or private equity or a hedge fund, you have 2 years to get rid of that investment. Now, if you can't get rid of it because it's a liquid, which is essentially the case for most of us, then you have to take a taxable distribution, which, guess what, Mr. President, will create income. So even if you make more or less, I should say, than the 450, you're going to have income. So that's why those two provisions will be reworked or be removed, because it could trigger income for those making less than 450. Now they can rework it and basically say, listen, if you make less than 450, you can do private placements, but that doesn't work. Why? Because private placements, essentially you need to be an accredited investor. Who's an accredited investor? Someone that earns $200,000 if they're single, $300,000 married, filed jointly, or have $1 million in net assets, excluding primary home, or have certain investment criteria. So if they added that threshold to 138312, it's only going to help people that make between 3 and 450. Because if you make 150, you still can't do that investment because you're not accredited. So, they're opening a can of worms. They're making things super complicated for no reason. Listen, there's less than 500 people in the whole country that have more than 25 million in an IRA. There's less than 30,000 Americans that have more than 5 million in an IRA. We're not talking about a lot of people here. And trust me, the people that have 5 million, I've spoken to a bunch. They've saved. They've done everything that the retirement system told them to do. And now they're being punished. I spoke to a gentleman a couple weeks ago. He said, Adam, I've been saving my whole life, literally since late 70s. I've been doing everything I can. I've worked on Wall Street. I'm not a super rich guy. I'm successful. I've made money. I don't have 10 million in an IRA. Why am I being punished? Why? I have over 5 million and I've done everything right. Why are they not going to let me do private placements? What's going on here? And ultimately he said, what happens if I do get to 10 million, right? I make a couple investments, time value of money, compounding returns, money grows. Your money doubles every 8 years. So if someone has $5 million in an IRA at 60 years old or 66, they could have 10 million in 8 years. That's the way compounding returns work. If you generate 8% of returns every 8 years, your money doubles. So someone who has $5 million in an IRA at age 50, age 60, they could have 10 million. Now they're going to be subject to the cap. So again, political trickery. What ProPublica, what Senator Wyden said is, say, look, 10 years ago, there were so many less people with big IRAs over 5 million. Now there's so many more. Oh my God, there must be so much abuse. No, sir. It's compounded returns. Retirement accounts grow faster than taxable accounts because they're not subject to tax. That is the whole point of tax deferral, compounded returns. Eighth one in the world. Ask Albert Einstein. So they're saying, hey, more and more IRAs are getting bigger. There must be some type of cheating going on. But no, it's not. It's just time value of money. Your accounts are going to grow over time. So if they look in the next 8 years, they're going to say, oh my God, so many more people have 5 million plus IRAs. We need to do more to stop this. There must be all these Peter Thiels at some type of secret club for rich people laughing at us because it's so easy to cheat the system and get money into a Roth IRA. No, sir. It's just time value of money. That's it. So it's too bad. They're hurting everyday Americans that want investment choices. They're hurting, more importantly, American businesses that count on IRA money to help them grow. I can't tell you how many clients, thousands of my clients over the last 12 years have used their IRA to invest in amazing businesses. Not all succeeded. By the way, this is something they haven't mentioned. 90% of all startups fail over 5 years. So it's not so easy to invest in PayPal, Palantir, and Facebook Peter Thiel is a super smart guy. I'm not going to sit here defending him because it's hard to defend a billionaire today. It's not something I want to take heat for, but he didn't do anything wrong, honestly. The IRS could have audited it at any point. They could have looked at his 5498 each year. They had 3 years to audit him. They could have audited him. They didn't. Supposedly they looked at this in around 2012. Either the statute ran or they decided he didn't do anything wrong, but they were not able to pursue any claims against him. The IRS has audit responsibilities. They can always audit these IRAs. If they see IRAs over 5 million, 10 million, they can always audit them. But we see, based off the revenue raised on moving the statute from 3 to 6 years, they perceive only $12 million of revenues over 10 years. What does that tell me as a tax attorney? That tells me they don't think there's a lot of money out there. Why? There's not a lot of abuse out there. They have 6 years to get you. And they only think going from 3 to 6 will only get them an extra 12 million in revenue. Clearly, they're telling you in black and white, not in political jargon, but in black and white, they're saying, yeah, we know there's not that much money out there. We know there's not that much abuse. But kind of plays well with the times we're living in. We're punishing rich people. Rich people are bad. Rich people are cheating. And unfortunately, there are some cheats out there, but it's not mainstream. It's not common. And it's unfair to punish you and me from doing important investments, helping us diversify, helping us boost our retirement growth by doing exciting private placement investments, and also hurting the foundation of our economy, startups, right? We got to compete with China. We got to compete with Europe. We're not going to be able to if there's no fundraising out there to raise money for these businesses. Startups need money to grow. There's $12 trillion of IRA money, which is only going to grow, not because people are cheating, but because of deferral and tax compounding returns. So if we eliminate that 12 million and just take it off the table, our economy will suffer. And that's just a fact. I'm going to do one more question. What about the people that have their IRA in Bitcoin? How are they going to be affected? So if you don't have $10 million, you're not going to be impacted because Bitcoin is deemed a commodity. So it's not subject to the accredited investor rules. You're not going to have a 10% issue, no private placement issues, unless you bought Bitcoin through a private placement. Then you could have issues, right? If you did a private placement of Bitcoin, you could have an issue, although I truly believe they're going to remove this 2-year window and basically grandfather people in. I'm not sure what they're going to do going forward. I'm very confident that they'll just remove 138312 and 138314 because it's going to do so much harm than good. And I think they're starting to understand that. But Bitcoin investors aren't going to have to worry. Even if you bought Bitcoin in an LLC, we'll just change who the officer of the LLC is to a third party like a spouse. And you'll be able to use an LLC to buy Bitcoin, especially as a passive investment. So I wouldn't worry about it. Now, again, I hope to have over $10 million in my IRA at some point. Why? Because of my crypto. So I'll deal with that at that point. I don't know if I'll get there before 59 and a half. I'm 46 and I've done well in cryptos. I'm not in the 5 million range yet. So I probably am not going to be able to get to 10 million before 60. So the cap may not be an issue because I'll have Roth funds anyway. So I'll just pull that money out. But either way, there'll be workarounds. There's always workarounds, whether your income below the 450 threshold or another administration comes in a few years and says, hey, we're going to do away with this rule. It makes no sense. We'll see. But again, my job here is to basically talk to you about the impact of current tax events on your retirement account. This Adam Live was focused on real estate. I kind of got off topic the last 10 or so minutes, but I hope I'll kind of come back to the real estate topic as a closing remark and basically saying, listen, there's a lot of negative stuff on this tax bill that we got to be aware of. There's not much we can do other than talking to our members of Congress or senators. Not a lot of tax planning. Why? Because they snuck in a very sneaky wording in the tax bill that basically said, listen, the capital gains provision, the 25%, it already happened. basically said you had to have done a capital asset transaction before September 13th. So they gave you like a day after the bill was announced, not even like 8 hours. So if you're selling something today in October, even though the provision is not passed, you're still stuck with the higher tax rate in capital gains, potentially other events too. Now, the net investment tax seems to apply that 3%, 3.8%. The net investment surplus of 3% seems to apply in 2022, not 2021, whereas the capital gain tax rate increase seems to apply to 2021. So kind of see how that works, but get ready to pay more tax if you're a real estate investor. Just be happy they didn't touch 1031s. That's probably the best news for real estate investors. Last question. Someone wants to know, having separate checkbook IRAs for IRA versus Roth. I think it helps if you're doing traditional and Roth, and I have separate checkbooks for my traditional and my Roth. Why? Because if I want to do distributions or I want to have different investments for Roth or traditional, much cleaner and easier to do if you have two separate LLCs versus doing some pro rata formula. So for example, if you have an LLC, own 50-50 traditional Roth, and it has two assets, everything's pro rata, right? You can't just say my Roth's buying asset A, my traditional's buying asset B. In an LLC, everything is aggregated. So you just have to do a pro rata combination. Whereas if you have two separate LLCs, you can say LLC 1's for Roth, LLC 2's for traditional, and here you can keep the separate investments separate in separate LLCs and also give you separate limited liability protection for each asset. So Kevin, that's what I would do. Thank you for that question. So there you go. I was trying to do 45 minutes, kind of went on a bit of a tangent on 138, 312, 138, 314. My apologies, but now you know. So if you are as frustrated as me, you can do something. You have a voice. Reach out to your member of Congress, reach out to your senator, talk to them about 138, 312, talk to them about 138, 314, and have your voice heard. Otherwise, thank you guys for watching. This is a weekly thing, so I know it's kind of a weird time, 12 o'clock, but the whole idea is supposed to be like a lunch and learn. I drink coffee mostly for my lunch, so cheers. Otherwise, thank you again for all your support. If you have questions, send them in to Meath via Facebook, Instagram, Twitter. Our YouTube channel is really great. I spend a lot of time. We drop 3 to 5 videos a week, 3 podcasts a week, plus my Adam Live each Wednesday at 12 noon. If you miss it one week because you got better things to do, which can't blame you, don't worry. This thing's taped. You can check it out anytime later on in the day, later on in the week, and hopefully you enjoy the content. I enjoy presenting. If you have ideas for future topics, future videos, future Adam Lives, just let me know. I would love to hear from you, and really appreciate all your support. Thank you so much again for watching, and talk to everyone again next week.